Hello everyone, and the waters are relatively calm here, but that's not necessarily the case everywhere, not in markets. If you take a look at a daily chart of the US 500, the Dow Jones, stocks just fell off a cliff. Will the fall continue to the downside? Most likely. I mean, when you get rock falls, there tends to be another one after it, a little bit delayed. So, I did want to mention that the school holidays have just started in New South Wales, which means all you wonderful parents at home with young children, you now have the children at home with you for the school holidays. Isn't that nice? No change at all to lockdown. A new experience. Wishing everyone happy family environments during the school holidays. In terms of being a happy family environment, I think, as we've been saying for many weeks now, you do have to actively protect, use various instruments to defend your investment portfolio, all of your assets really, if you're in Australia, against further downside. Iron ore price halved in value. I mean, it's really, that iron ore price is really taking away the veil from the real substance of the Australian economy, which is not that great. Without stimulus, we would have had an ongoing recession. We're now in a different sort of recessionary risk period though. And what I wanted to really highlight is that this is a new economic environment. It isn't a rerun of the first COVID crisis that we had. I've mentioned before numerous times, we don't have the same stimulus measures as back then, and that's probably a good thing. We probably had, I'm pretty sure we had the highest stimulus per capita ratio in the entire world. No wonder everyone thought the economy was booming. But what all of those measures did, like spending of superannuation, tax breaks on and incentives for home renovations, business renovations, all that sort of activity is sucked forward. And I said it at the time in real time, I'm not saying it in hindsight. It's sucked forward from the future into then all of future economic activity over the next 2 to 3 years of that nature. And that's where we are now. We're now in the void of that future period where there's not a lot of new orders for new renovations that aren't already in the pipeline. Of course, there's still things in the pipeline, but that pipeline is going to start to dry up, and then we're in serious trouble from tradies to retail. Retail is going to have a very difficult year going forward. It's going to have a nice little rebound, certainly, as we come out of the lockdown period, which we most certainly are, despite what will be, I think, quite a significant and more alarming human price than governments would like us to believe at the moment. I like how all the modelling in Australia has this nice rolling over curve of cases. That doesn't at all match up with the experience of Israel, the United States or UK, where it's that. So it's nice to have this modelling. I hope the modelling's correct. The reason I'm talking about all this is you have to understand that where Australia is at the moment is not a good place. We've already spent an enormous amount of money on stimulus, racked up a lot of debt. We have a central bank that doesn't understand the inflationary pressures of our time. Therefore, we're going to have monetary policy that remains behind the curve, at least for the next probably 1 year, maybe even 2, 3, 4, 5 years. It is an institution that needs a shake-up, and the OECD agrees with us on that, saying that there seems to be really a deep-seated need for a complete rethink of RBA policies and that sort of thing. So, on top of that, we've got Australia has now decided to have this new alliance with the US and the UK, and it is an alliance that hasn't included anyone else in Asia and has alienated the French and parts of Europe. So I don't know if it's a step forward or 2 steps back alliance, maybe it's both. But again, that's going to increase this concept in Asia that Australia isn't really part of Asia, and that's not a good thing. And it further alienates our biggest trading partner, which isn't a good thing. So what I'm trying to say to you is the domestic economy is in trouble. Our mineral exports are in trouble. Commodity prices, many commodity prices falling. Some are going up, like coffee, but plenty of commodity prices are falling. Iron ore is halved in value, and China doesn't want to import as much from us anymore. It wants to import as little as possible. It's only importing what it has to from Australia. So that number is going to diminish. The level of exports in general is going to diminish. Agriculture will remain strong. That's the bright spot in the Australian economy, agriculture. The other bright spot in the Australian economy is using a financial institution to hedge against potentially significant downside risk in Australian equities, as also that gets supported by the idea that US equities are falling, and that will accelerate the Australian downside even more so. And the US dollar is strengthening just as the Australian dollar was weakening anyway. So again, it's a double whammy sort of pressure point on the Australian dollar. I have been suggesting gold is a hedge against Delta. It's not working out in the short term. It seems to be responding like currencies, but keep an eye on gold. When you see the euro, sterling, Australian dollar making new lows, but gold starting to edge up, that will be the breaking free point where gold becomes that risk against, that trade of, that hedge against the risk of uncertainty regarding Delta, inflation, and a general economic slowing around the world, which is happening, and we forecast just when everyone else thought the world was just going to be this beautiful nirvana place, which it is out here. But in financial markets, it was way overheated, and it's a correction that we all needed to have in terms to build strong portfolios in the long term. Remember, you can empower your investment strength by managing downside risk moves more effectively than perhaps other people do, which will just give you a greater strength on the next upswing. Clifford Bennett, Chief Economist, ACY Securities.